First-time home buyers, the loan process from start to finish can be quite stressful, and it's mostly because you don't know all that goes into it from the lender's perspective. So let me walk you through it. You start off with an application. It's usually a 2 or 3 page application. They're looking for detailed information on your income, your debt, your assets. Income beyond wages could be investment, whether it's in the stock market or perhaps you have a 401k, property, real estate property, debts. That includes your credit cards, any other loans like a car payment, maybe you have child support payments. And then assets, they're talking tangible things like vehicles, property, anything that has not a cash value but does have a value if you were to sell it. And once you've got the application in, the bank usually will do kind of a soft pull of your credit to give you a pre-approval letter. And the whole point of the pre-approval letter is to kind of give you a ballpark, what type of loan program they're going to try and get you approved for. It also gives you a price range on what type of price you can afford, gives you your closing costs, so you'll know upfront what your down payment is, what kind of cost you'll incur to apply for that mortgage and get it. And then it also lets you know, based on what program it is, whether the house you're looking for will pass or not for that program. So even though you can afford to buy a house, the house itself might not qualify. And you really need that pre-approval when you go to write an offer on a home. It lets the seller know that you've already started your homework and have talked to a lender, and the lender says, yeah, they're looking like a pretty good investment for us as far as giving a loan. Lets them know what type of program you are applying for. So as realtors, we can tell you whether a house will or won't qualify. And what we mean by that is VA loans for veterans, or FHA, which is another government loan program, are probably the strictest 2 programs out there. And the government just wants to make sure that the home meets safety and structural standards, that it isn't a hazard in some way. And of course, the government wants to make sure that they're giving out a loan that has a property they might be able to resell if you actually become delinquent. So the house can't have missing shingles, chipped paint, missing handrails on staircases or banisters at all. Decks, have to have good solid wood. It can't be deteriorating. Electrical system has to be relatively recent. It has to have GFCI breakers, essentially. All those things are required for those 2 loan programs. So if any of those are missing, it's kind of a light bulb moment for us as realtors that might not be a good home for you. So once you get an accepted offer on a home, then the lender does a more deep dive into all of those things you put in your home application. So they're going to want copies of your wage statements, 2 years of your tax records. They're going to verify all of your income sources with your employer, your investment broker, whatever you supplied them with. They're also going to ask for statements for any credit cards or loan for cars and such that you have out there. They then do a hard credit pull and check for any judgments you may have against you, whether it's a divorce decree, a child support payment, past due medical bills. That usually happens within the first 2 to 3 weeks. Once they've gotten through that hurdle and you're approved as far as your finances go, they then order an appraisal. And the bank takes care of that. They have approved appraisers they use, or they've got a blind system and they just put an inquiry online stating we have this home, we want to have it appraised. And the appraiser then schedules it. From the day that they view the house It usually takes at least a week, sometimes 2, for them to create the report and get it back to the bank. Once the bank has it, they take all of that information, your finances and the appraiser, and they send it to their underwriting department. The underwriting department is kind of like the insurance look over team to make sure that you are a good risk for them to take as far as a loan. Underwriting approves it or says, hey, there's a couple more things we still need you to verify for us. Or in the case of an appraisal, maybe the appraiser said, there's this issue and the bank wants it fixed, or they've got a question about it. And once everything is taken care of, all of the answers are in, underwriting approves it, then you can finally move on to closing. Title company does a title search. They start that at the beginning of the whole process, looking for any judgments or liens against the property, against an individual, either on the buying or the selling side. And once title company search is done, underwriting's approved the loan for the buyers, then we can go to closing. And simply that is a statement the title company comes out with listing the cost for both the buyer and the seller, how much money the buyer needs to bring, and you sit down and sign papers, and that's when the deed actually gets transferred and recorded. Title insurance is paid for by the seller. And that is in case the title company didn't find something, a lien against the property or the seller, then the title insurance would kick in and pay whatever that judgment or lien is, so that the property is free and clear and the buyers can safely feel that they own the property. Lenders also have a title policy that they require when there's a mortgage on a property and the buyer pays that. I have a document on my webpage that details kind of closing costs and who pays for that. So feel free to check that out. If you got questions about the whole process, want more detail, again, you can check out my website, my blog. And then, of course, give me a call, a text, an email. Thanks so much.